Hey everyone, Aaron Vincent here, Vincent Financial Group. I'm here with my business partner, Matt Decker, and today we're talking about all the different types of money buckets. You may or may not know what I'm talking about, but Matt, what does that mean?
So everybody talks about diversification. And in most cases, when a financial advisor is talking about diversification, they're talking about diversifying your money into different investments. We're going to put a little bit of a spin on that here today. We're going to talk about diversification in all kinds of different ways. Stay tuned. Hey, it's Matt Decker with Leverage Wealth Management. I'm here with my business partner, Aaron Vincent. And today we're talking about diversification in all kinds of different ways. And the way that we're going to do that here today is by looking at a bunch of different buckets. So you've seen me with the iPad before. You may be wondering, Matt, why do you have that blue pen? Because my kids stole my Apple Pencil. And so today, my handwriting is going to be less than subpar.
Matt, let's be honest. It's always less than subpar, but it'll be even worse today.
It'll be even worse today. That's true. You may not know that these are buckets, so I'll add a little deal here. So we're talking about diversification. And like we said kind of at the outset here, most people think of diversification as like, I'm going to own different kinds of stocks or bonds or mutual funds.
Yeah, diversification from a risk perspective only.
Yep.
How risky, how conservative, that's what that means to everyone.
Exactly. We're going to go a little bit more in depth today. And we've got three different classifications of diversification. And we're just going to call them three buckets. So 3 buckets in 3 categories. We got 9 buckets. It's going to be fun. So I'm excited to do this for you. Where we're going to start is talking about tax diversification. So Aaron, in your words, what is tax diversification while I massacre this iPad with my terrible handwriting?
Yeah, so as we alluded to a minute ago, diversifying obviously just means not having everything in one place. That applies also to taxes. So there are different ways that your money can be taxed. It can be taxed or it can be in a bucket that is tax-free.
So that's bucket number 1.
Okay.
Bucket number 1, tax-free. Okay. Tell them what's in the tax-free bucket.
Examples of tax-free options would be like a Roth IRA, for example. And what that means is that when you get the money out of your bucket in the future, it comes out tax-free. That's what we mean by tax-free. So Roth IRA, the most common one probably.
And Roth actually comes in all kinds of different forms, right? You can have a Roth IRA, you can have a Roth 401k, you can have a Roth annuity, you can have all kinds of stuff. Roth just is a piece of paper that gets stapled to the front of an investment that says, hey, you already paid the tax, you're not paying the tax anymore. So all the Roth accounts, tax-free.
Yep. Technically, you want to put muni bonds in this category because, again, from a tax perspective, they do have that benefit.
What's a muni bond?
Muni, short for municipal bond. The long story short is that when cities or governments or any really municipality wants to do a project, for example, they need to raise funds. And so they will go to the people around them and say, hey, we need to raise funds for this building or for this road or for whatever it might be.
Or sports stadium,
parking garage, you name it. Anything that needs to be built or done. They raise funds by selling bonds. And the advantage of those particular bonds in that category is that the dividends or the returns you get on that investment come out tax-free.
And we all know that municipalities are phenomenal stewards of their own money.
I caught your sarcasm.
Okay,
yeah. If
cool.
you read the news in the past couple of years or watched it, you know that there have been, they've gone bankrupt. Some have gone bankrupt.
Yeah.
So yeah.
Well, lots of bonds can end up being not so great.
Yeah, that's a bond issue, not really a muni issue.
Correct.
Yeah.
Okay. And then what else?
Thirdly, really only 3 go in here for the most part. And the third one we talk about a lot and we like a lot, would be the cash value in your life insurance policy.
So I'll just put CVL.
Cash value life insurance. Yep.
Cash value life insurance. Yep. Okay, so that's what is in the tax-free bucket. Have we missed anything? I would say if there's going to be some sticklers out there, you maybe could put real estate income if it's offset by depreciation.
Right.
But that's a tricky kind of, you're on the hamster wheel because that depreciation doesn't last forever. Yeah. So we'll just put question marks next to real estate. You have to have depreciation. How long does that last? Well, do you accelerate the depreciation? You probably do, which means it's not going to last as long as it normally would, so on and so forth.
Yeah.
Hey, we're trying to do our best here. This is not going to be a 2-hour long video. For the sticklers, cut us some slack. Okay. All right. What else? We got the tax-free bucket. What's the second bucket that you want to talk about, Aaron?
The other one, it would be taxable.
Okay. Taxable.
And it'll make sense more as we go through, but you might think that isn't everything else taxable? If you've got a tax-free bucket, are there two more categories? Well, there are, but the taxable bucket is really anything that when you contribute to this bucket, the returns that you get are taxable to you in that year. So
in the form of a
1099.
Bingo. That's what I wrote down. 1099.
Yeah. You will get a 1099 every year on the growth in that bucket. So if you invest in we call it non-qualified, any sort of non-IRA, non-401k, non-403b investment account. It's non-qualified. It's money that you're putting into this investment account that you've already paid tax on. Put it
Perfect.
that way. As you get returns on that, then that money comes out, or I should say, at the end of the year when you do your taxes, you will get a 1099 for the growth in that investment. It's taxable.
And real estate could show up in this bucket as well.
Absolutely.
Once you run out of depreciation. Okay. So taxable bucket generates 1099s.
Yep.
Pretty simple. Lastly, also taxable, but doesn't generate a 1099.
No.
So what is this last bucket?
Yeah, the last one is by far the most common. I forget the stats now, but isn't it something like 30 trillion? Don't quote me on that. Of America's retirement dollars are in this bucket. But tax deferred simply means you contribute to this bucket, you invest in this category of investment, and when you put money in this bucket, the taxes that would normally be due are deferred until later. There is no 1099, put it that way. And therefore, when you take the money out down the road for retirement purposes or whatever else, the money's taxed at that point. That's why it's called tax deferred. You're deferring your taxes till later.
And how is it taxed, Aaron? I don't know if maybe you already said it, but
No,
how
I
is
did
it
not.
taxed?
Ordinary income taxes.
That's
So
right.
whatever income tax bracket you find yourself in at that later time down the road, that's how your taxes are calculated in this bucket.
I'm trying to do a semi-exhaustive list. Help me out, Aaron. I got 401k, IRA, SEP, Simple, 403b, TSP,
Wow.
Solo, 401k.
Pretty much. That's all the big ones. Again, for the sticklers out there, yeah, you might find a couple more, but for 95% of the people out there, that's what this is.
In a weird way, a non-qualified annuity actually can kind of find itself in this bucket because it is tax deferred, although it is taxed differently. But that would kind of be in that bucket there. Okay, I think we've got it. So when we talk about diversification, the question is, are you diversified from a tax standpoint? You may own all kinds of different stocks, bonds, mutual funds. You may own real estate. You may own crypto. You may have cash. You may have several businesses, but are you diversified from a tax standpoint? So your homework is to look at these tax buckets that I've drawn that really just look like chicken scratches. And you need to ask yourself this question: where's most of my money? Where am I saving most of my money? And you should just be aware of that because if you are saving everything into one bucket, if everything's going into a tax deferred bucket, are you diversified?
No, by definition.
I would agree. I would say you are not diversified. Okay, let's move on. So the second type of diversification that I'd love to talk about is, let's just say, how do you earn your returns? So I just got a big percent mark there above the buckets.
Yeah.
How do you earn your returns? I'll take this one in terms of lining them out. So let's start with percent, or we're also going to put risk up here just to add a little bit more clarity. So we'll say unlimited upside, unlimited downside. What does that mean to you, Aaron?
It means volatile. Lots of risk. You may have a great year and see a huge percent return and you're loving this. But the exact same investments the next year, you could be hating them. They could be down big.
So you can earn a return on your dollars by investing in things that could literally go to zero and be worthless, or could go to the moon. So the types of things that would fit into this bucket would be any type of stock portfolio is an unlimited upside, unlimited downside risk. Crypto, unlimited upside, unlimited downside. Essentially, you don't know what your return is going to be, and you could make or lose any amount of money. That is one way to earn interest on your dollars. It's probably the most common way because most people are invested in the stock market.
Yeah, equities.
Yeah, I'm going to put equities here. We'll put equities. We'll also put crypto here, just so people know. Equities, crypto. There's a lot of other things that could go to zero or go to the moon, but again, it's not an exhaustive list. Need you to cut us some slack. The middle option is, we're going to call this a hybrid option. And the reason that I'm calling it a hybrid option is because it's going to have limited upside and it's going to have limited downside. This would be similar to what we would talk about in like an index life insurance policy that we do talk a lot about, or an indexed annuity.
Yep.
There's also variable products that are called like RILAs, where you can kind of dial in how much risk you want to take. And that's going to come with some upper limit in terms of what you can make.
Choose the cap on the upside, allows you to choose the cap on the downside, and you get whatever's in between. Yeah, exactly.
That's right. And so I don't think that we need a ton of examples in here, although we'll just say it's going to have limited upside.
We could get really technical here and get into options and all kind of stuff, but I don't think for the sake of this video, like you said, it's not going to 2 hour long video.
Limited upside, limited downside. In some cases, you get the choice of what you want that upside and downside potential to be, but this is a hybrid. It's not unlimited in either direction.
Correct.
Is that a fair way to, talk about this middle bucket? Okay. And then the last bucket is the easiest one. It's just fixed. Tell the people, Aaron.
You know what you're going to get before you start.
Exactly.
That's the easiest way to say it.
CDs. Yeah. You could put a bond in there because you know if you're going to hold the bond to maturity, that would be fixed. Fixed annuities, savings account,
cash, all of it.
All of it. You know what you're going to get. You're not choosing the upside or the downside. It's chosen for you to the penny. You know what you're going to get. And so if we were also to talk about kind of diversifying here, it's obvious that your highest upside is on the left, unlimited upside, and your lowest upside is on the right, fixed. The fixed rate is not going to outperform the unlimited bucket, except in dire, catastrophic, tail and black swan scenarios.
Yes. Exactly.
Okay. And then the same is true for the hybrid. The fixed option should not outperform the middle option because you're taking less risk. And we tell people all the time, hey, if you want a return, you have to take risk. There is no return without risk.
So Matt, which one should I put my money in? Which one's the best?
Exactly. Well, what are we talking about today, Aaron?
We have to design it. Diversification.
We're talking about diversification. So again, same question. Where's your money? Is all your money in the unlimited up, unlimited down bucket?
Hope not.
Well, I mean, if it is, hopefully you take inventory of
I guess
that.
I should say that's true. As long as your goals are aligned with that, it might make sense.
Do you want to be there? Okay. Is all of your money in the fixed bucket? Do you want to be there? You know, you have to really just assess this for yourself. And if you need help assessing where you should be, that's where we come into the picture. But we just want to let you know what's available.
Well, and the question that or the conversation we often have, people ask us all the time, how much risk should I take? And I think the answer is never too much, but enough to reach your goals.
No more than you have to
No more than you have to
live the life you want to live.
Yep.
Any more risk doesn't make much sense. All right, let's talk about the last set of buckets. And this is going to be, how do you generate income? And this is a little bit different. Most people don't talk about how you generate income. And again, this is not exhaustive. You can generate income all kinds of ways, but we've really simplified it. We've boiled it down to the most common ways that we see people generate income. And so I'll take the first one I forgot the handles. Let me get the handles so that you guys know what we're actually doing here. These are buckets.
Bucket.
They're buckets, guys. All right, so income. This would be, the first bucket is going to be, we'll call it the 4% rule. Now, this is way oversimplified, but all I mean by the 4% rule is you've got a basket of securities or a portfolio, and the way that you're going to generate income, and we're talking about retirement now here, you're generating income for retirement, you've got this basket of securities, you've got this portfolio, all this money that you've saved up. How are you going to generate income? You're going to sell a portion of that every single year to fund your lifestyle.
This is the most common way. I mean, if you were to Google this right now, you'd find an example of a $1 million portfolio, and you take 4% off per year. That's $40,000. Then you add your Social Security to it. Now you've got $70,000, and you have a $30,000 pension. That's how you have a $100,000 retirement. That's the 4% rule. This was calculated years and years and years ago. You'll find people saying that it should be 5 or it should be 3, but it's very common.
And you actually did people a favor that most people don't get. The reason this is the most common of the buckets from an income standpoint is because years ago, companies did away with pensions. And so you mentioned, $100,000 or $1 million portfolio with a pension, $30,000 pension. Well, nowadays, most people aren't getting pensions.
Right.
If you have one, it's probably not being funded anymore. The reason that most people find themselves here in this sell off your assets to fund your lifestyle bucket is because companies started switching to 401ks. Mm-hmm. And if most of your money's in a 401k, then that's what you're doing, to fund your lifestyle. Unless you make changes, what you're doing is you're going to sell securities each year to fund your lifestyle.
Right. The idea is if you only sell 4% and not more, you will not run out of money.
And I would say that that's loosely accurate.
It has been over the years. Yeah.
Okay. We've got a middle bucket here. So we've got the 4% rule where you're selling assets. This middle one is going to be, and these are not technical terms. These are terms that this is how we conceptualize this. So this middle one is going to be more, you're going to give your money to an entity and that entity is going to pay you some kind of yield. Okay, so we're going to call this, I guess it would be like a bond ladder would fit into here. This is not the category of the bucket, but this is, you're giving up, it's almost like a pseudo annuity or pension where you're going to give someone some funds. So whether you buy some bonds and those bonds pay a yield and you're going to live off the yield, that's one way to do it. Or you're going to give money to an annuity company. The annuity company is going to give you some kind of payout, but you might still have access to your funds in the meantime.
Right.
What am I missing here, Aaron?
Well, anything that you invest in and you agree that you're only going to take out as income, the returns.
Right.
Yeah. So that could be a lot of things. I think those are great examples, but anything where you decide in advance, I'm not going to sell the principal, like bucket number one. I'm just going to live off of whatever the returns are on that investment.
That's a great way to put it. You're not dipping into the principal. In option number one, you most certainly are dipping into the principal at some point.
Yep.
In option number two, you're not dipping into the principal. You're only living off.
In that $1 million example, you never get below $1 million because you're only selling what the returns are on that $1 million.
Is it principal or principal? We just did 100 takes. Okay. And then the last one is taking the middle bucket to kind of the extreme,
right,
which is going to be like a life-only option.
You mentioned the second bucket is a pseudo pension. This is a actual pension.
This is an actual pension where you're going to take the dollars that you've earned. Now, these dollars could have been in the 401k, and you're going to make the choice to hand all of those dollars over to some other entity. Most oftentimes it's an insurance company, and the insurance company is going to take your principal. You're not going to get it back.
Yep.
They're going to give you a payout. And when you die, the payout either completely goes away, that's called a life only,
yep,
or you may have the ability to choose like a survivor benefit. But the bottom line is this: you are trading your principal for a payment, and you no longer have access to the principal.
We'll use the same example. $1 million, you give your $1 million to that company. You no longer, if you change your mind, you don't have your $1 million anymore. You get a monthly check in the mail instead. That's what the deal is.
Just the check.
Guaranteed.
I wrote here, no more access to principal, just a payment.
Yep.
Now, that doesn't mean it's a bad option.
No.
It just means that's how it works.
There are very few of them left.
Correct.
I guess you could create your own with an annuity.
Correct. So we've got 9 buckets here. We've got 3 buckets for tax diversification: tax-free, taxable, tax-deferred. We explained what all those are. We've got 3 buckets for how you can earn interest on your dollars. Again, it's not totally exhaustive. We're just trying to make it simple and to the point. You can have unlimited upside, unlimited downside. You can have some kind of hybrid where you've got maybe a limited upside, but you also got limited downside. And then you've got just a straight fixed option where you know exactly what you're going to get every single year. That's also in order of risk. Okay, most risky, unlimited; least risky, fixed. That's pretty self-explanatory. I think you all know that. And then the last one is, well, when you get to retirement, how are you going to generate your income? Well, there's 3 buckets. You can sell off your assets. You can live off of the income and not touch the principal. Or you can give all the principal over to an insurance company and you can live off a guaranteed payment.
Yep.
So the question becomes, are you diversified?
There is actually a correct answer for you for how much money should I have in these different buckets. I mean, if you can identify 2 different variables, what you have today or what you will have when you turn 65 or whenever you want to retire, if you know that amount of money and you know what income that you want to live off of for your retirement, if you have those two variables, there actually is a correct answer for you for how much of my money should be in each of these 9 buckets.
And what I'll say also on top of that is the correct answer is almost never something like this. Well, we got to get all your money from this tax deferred bucket into this tax free. And we also got to get all your taxable money into this tax free bucket. And we got to get all your unlimited money into this hybrid model and all your fixed money into this hybrid model. And then we got to get all your money into this life only option. So choosing one bucket for all your money out of the 3 categories is almost never the right answer.
Yeah, bad idea.
So if you're talking to somebody that says, hey, we got to get all your money from here to there, I would question that strongly because getting all your money from one place to another is almost never the right answer.
Correct. Yep.
Because that's not true diversification. Back to the original point, you got to be diversified.
You want to have options, right? No one knows what life's going to look like 10, 15, 20 years from now. So having options is a good thing.
If you want to learn more about this and how we come up with the right mix of your assets and how much of your money should be in the different buckets, you should absolutely reach out to us. This is what we do on a daily basis, helping people kind of tackle these tough questions. And our goal is not to, like we just said, get all your money from one bucket to the next. That's not the goal. The goal is to figure out what you want to do. The goal is to figure out how you want to live your life, what's important to you. How comfortable are you with risk? And then on the back end of that, we take all that information and say, okay, well, if these are your goals and this is how fast you want to get there and this is what you have to work with, this seems to be the best way to get what you're looking for and still stay within, your risk parameters so that you can sleep well at night and not worry about the market or, am I going to outpace inflation or what happens if taxes go up? No, the goal is to have an answer for all those things.
Absolutely.
And that's how we can help. So if you'd like us to help, we're going to put a little call out card somewhere on this video. I don't do that and Aaron doesn't do that, but we'll put something up there and you can click on it. And when you click on it, it's going to take you to a place. And that place is going to give you an option to book some time with us. And you should do that if this is something you want to learn more about. Until next time.